So similarities and differences. So the RSP, contributions are made before tax. That is what everyone loves. I put some money in, I get a refund, all things being equal. There are government limits on contributions. Your tax deferred growth. So you put money in, any growth is not taxed right now. But on the other hand, all proceeds are 100% taxable.
At IB Canada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
How much does it cost? We get this quite a bit. How much does it cost? Generally, someone say, I need a quote. I want to know what's the cheapest for this amount of insurance. Well, let's chat about that. So we're going to come up with some theoretical numbers here, okay? So there's a minimum amount you can pay for any given amount of coverage, right? There is also a maximum amount you can pay for the same amount of coverage. Now, why would someone even want to think about paying more? We'll get into that. So the minimum amount is determined by the insurance company. They say, based on our actuaries, and insurance companies are very good planners, say based on our actuaries, we expect this many people to die, it costs this much to run our business. You've got to have this much money for the policies on the books so we can be a viable business over the long term, over the next 100 years. And we need to have a little bit of a profit. So what do we need to charge as a minimum to make sure that happens? And the insurance company does that. Now, on the other end, the maximum premium is determined by the government. Why would that be? Well, there's an infinite amount of premium options between the minimum and the maximum. Now, the why. In the 80s, the government decided to pass laws limiting how much money you could put into a life insurance contract. Why would they do that? That doesn't make sense, does it? Well, it will. The reason was to not allow life insurance contracts to have an advantage over RSP accounts. Why is that? Well, if you put more money in your RSP, then the government can get a better cut. If you're putting it in life insurance and it operates how it should, then the government will have no cut to get. So similarities and differences. So the RSP, contributions are made before tax. That is what everyone loves. I put some money in, I get a refund, all things being equal. There are government limits on contributions. Your tax deferred growth. So you put money in, any growth is not taxed right now. But on the other hand, all proceeds are 100% taxable. So no matter what reason that comes out for, except for two, they allow you to do loans, but if you don't pay back, it will still be taxable. Whether you pass, whether you withdraw because you're having a tough time in life, whether you withdraw because you see this opportunity you can't pass up on, it doesn't matter. All proceeds are 100% taxable, right there, 100% taxable. Now, life insurance, the premiums are paid with after-tax dollars. Boo, no deduction. There's a reason for that. So there's no government limits on contributions. Hold on a sec, that's a little bit contradictory. Didn't we just say the government determined what's the limit? Well, there's no government limits on contributions based on how much insurance you qualify for, right? And to back that up a little bit, the government, if they say you have this much insurance, they put this much of a limit on there. Now, they're not stopping you from getting 10,000 or 5 million in insurance. So that's where we say there's no government limits. And within that higher amount, then you can have higher contribution limits. So that's why that might seem a little contradictory, but not really. Okay. You do also get tax deferred growth, and your debt proceeds are received tax free. Let me say that again. Your debt proceeds are received tax free, and you have access to account values through loans. Now, this gets glossed over quite a bit, but this is so important. You have access to account values through loans, and we're going to get into that a little bit more. So policies with premium above the maximum allowable contribution by the government, or as we call it, MTAR, maximum tax actuarial reserve, that's a mouthful, is required to be treated like an RSP, the same rules, regulations, and penalties. So that's why we don't want you going above that line, and we get things set up to make sure that you don't. While we are talking about RSP accounts, let's talk about what they do. What are the good things? Well, they do two things. They defer tax as we spoke about before, and the tax calculation. Because let's face it, while we're depositing, do you know what rate that's going to come out at? Unless you have a predetermined plan, you're taking it out. What if it's a year when you have income? Maybe you have a bonus and you decide to take it out. What if the government changes the tax rate? We don't know what the calculation is going to be going forward, right? A more accurate statement would be we postpone the taxes and the calculation, right? Because it's going to happen. For that money to be used, there will be taxes based on whatever tax calculation makes sense at the time. So the first question you should ask yourself is, what tax bracket will I be in when I withdraw the money? That would make sense, wouldn't it? You'd want to know, right? The second question is, what deductions will I have when I take the money? Will I still be working? Will I be under 872? And we can always chat later about why that number is important. So let's assume you want to purchase 500,000 of coverage, right? Let's run with that number. Let's assume the minimum that the insurance company determines that you have to pay for that is only $500 a year. The maximum that you could put into that, staying below that, we'll call it that MTAR line, is $10,000. Now, most people are going to say, well, why in the world would I look at $10,000? I'll just pay 500. Why would I go spend way more money for that coverage, for the same coverage? Well, we ask which premium option looks the best. Most people are going to say the $500 because logically, in our minds, that makes sense. We pay less for the same amount. But is that what we're really doing? The lowest premium is called term insurance, and nothing wrong with term. It serves a purpose, right? It covers you for that term or time period that you select. So if it's a 10-year term, for the next 10 years, this is going to be your premium. And whether that's 20 year, 30 year, 40 year, all points in between, this is your premium for this amount of time, and you have this coverage. So you get to do that. That's a possibility. It offers one benefit. If you do not die within the time period, which 98% of people don't, then the insurance is gone. Now, why would we get insurance with only 2% paying out? Because simply, we don't know who and when. So we want to make sure we're prepared to take care of our families and other obligations, right? Less than 2%, as I said, of term policies in force ever pay a benefit. So let's forget insurance for a moment and talk about benefits. Let's talk benefits, right? Because we know when we mention insurance, a lot of people just kind of tighten up and I don't want to hear this. But let's talk benefits. When looking for a place to put your money, it makes sense to look for the most benefits possible, right or right? Now, if you could wave a magic wand, what benefits would you want? Well, let's look at a few. Would you want tax-deferred growth on your money? I do. How about tax-free distributions? This is sounding better and better. Remember, this is the investment you would like to have, right? How about competitive return? You're speaking my language. High contributions? That is good to know. Additional benefits? What could those be? We'll chat about that. Collateral opportunities. Well, that sounds like a mouthful. Collateral opportunities. Okay. Safe. Hey, that is key. I don't want to be losing my money if I'm putting it away. No loss provisions. Oh, you are speaking my language, right up my alley. Guaranteed loan option. Loans. Well, okay. Well, it's good to have it, I guess. Unstructured loan payments. Now that's getting interesting. Unstructured. Liquidity, use, and control. I like those three words, especially together. And deductible contributions. Oh, wow. I don't even think something like that exists. Well, let's get back to life insurance now. So when we hear the words life insurance, we tend to think about getting the most coverage for the less premium. Again, most for least, most for least. That's why people try to shop and go, what's the cheapest, right? Remember our examples back to want and need, right? Do we ride the bus or do we buy a car? The bus or the car? The car is not the cheapest, but the car gives us the wants that we have. So life insurance policies are most efficient with the maximum amount of premium being put in. just in an MTAR guideline, which in this case we talked about was close to 10,000. Now, if you look on the right again, you will see that all these benefits are advantages of life insurance. The tax-deferred growth, the tax-free distribution, the competitive return, the high contributions, the additional benefits, the collateral opportunities, safe, no loss provisions, just music to my ears, guaranteed loan option, unstructured loan payments, liquidity use and control, but all but one, the deductible contributions. You can't get everything, but you know what? All but one ain't bad. So that is life insurance. The only benefit that permanent coverage does not offer on the list is the tax deduction of contributions. That's it. All the rest are part of the package. So life policies that offer the maximum amount of benefits and perform at their maximum potential with premiums up to that limit that the government allows, or as we call it again, the MTAR line. So now I'm pretty sure we piqued your interest. Still, you need to get between that 500 and 1,000 and 10,000. We'll chat more. We'll do another video and you can have some more information on that. Thank you for hanging out. Glen Griffiths here.
IB Canada Group, your independent authority for information on the infinite banking concept.